How credit scores actually work. Most people believe their credit score measures how responsible they are with money. In reality, it measures something very different. Your credit score exists to answer one question only. How likely are you to repay a loan on time as agreed? Once you understand that, the entire system suddenly makes sense. What a credit score really is. A credit score is not a judgment of character. It does not measure intelligence, income, or financial discipline. It is a statistical risk model. Banks, lenders, and financial institutions use it to estimate risk. Specifically, the risk that you will miss payments or default on debt. Your score is based entirely on past behavior, not future potential. Why income does not matter. Many people assume a higher income automatically means a higher credit score. That is not true. A credit score does not care how much money you earn. It only cares how you have handled borrowed money in the past. Someone with a modest income but predictable payment behavior can have an excellent score. Someone with a high income but missed payments can have a poor score. Predictability matters more than wealth. The 5 core factors. In the United States, most credit scores are calculated using 5 core factors. Each factor measures a different type of risk. 1. Payment history. The most important factor is payment history. This measures whether you pay your obligations on time. Late payments signal uncertainty. Missed payments signal higher risk. From a lender's perspective, consistency is critical. A single late payment can matter more than months of on-time behavior. 2. Credit utilization. The second factor is credit utilization. This measures how much of your available credit you are using. Using a small portion of available credit signals control. Using most of it signals financial stress. Even if payments are on time, high utilization increases perceived risk. 3. Length of credit history. The third factor is the length of your credit history. Older accounts provide more data. More data reduces uncertainty. Closing old accounts can shorten your credit history. From the system's perspective, a longer track record is safer. 4. Credit mix. The fourth factor is credit mix. This looks at the types of credit you have used. Credit cards, auto loans, student loans, and mortgages are treated differently. A varied history shows experience managing different forms of debt. This reduces uncertainty for lenders. 5. New credit inquiries. The final factor is new credit inquiries. Applying for multiple loans in a short period can signal distress. It may suggest someone is searching for access to cash. That increases perceived risk. Occasional inquiries are normal. Frequent inquiries raise questions. What credit scores do not measure? It is important to understand what credit scores do not measure. They do not measure savings. They do not measure net worth. They do not measure financial knowledge. They do not measure long-term stability. They only measure borrowing behavior. Why the system feels unfair. Many people feel the credit system is unfair. In some ways, they are correct. The system rewards people who already have access to credit. Avoiding debt entirely often results in limited data. Limited data increases uncertainty. From a lender's perspective, uncertainty equals risk. Why paying off debt can lower scores? This explains a common frustration. Paying off debt can sometimes lower a credit score. Not because repayment is bad, but because it reduces available data and utilization patterns. The system reacts to data changes, not intent. Common misunderstandings. Many people believe checking their credit score hurts it. It does not. Others believe carrying a balance improves their score. It does not. Interest payments benefit lenders, not credit models. The system rewards predictable repayment, not ongoing debt. Why the system exists. Credit scores exist to standardize risk. They allow lenders to make fast decisions at scale. Without them, lending would be slower, more expensive, and more selective. The system is not designed to be fair. It is designed to be efficient. How to think about credit scores. A credit score is not a goal. It is a reflection. It reflects how the system interprets past borrowing behavior. Understanding how it works removes confusion. And clarity allows better decision-making. Final words. A credit score is not about how good you are with money. It is about how safely a lender believes it can profit from lending to you. You do not need to like the system, but understanding it allows you to navigate it intelligently.